The broadcast is now starting. All attendees are in listen-only mode.
Good day, ladies and gentlemen. Welcome to Standard Bank webinar hosted by Standard Bank Financial Consultancy. My name is Teresa and I'm the coordinator. Today we'll be discussing the tax advantages of a retirement annuity in a landscape of increasing tax rates. Our presenter is Errol Meyer, who is the head of advisory.
Thank you, Teresa. Well, good day, all attendees. Welcome to our first webinar in 2018, and we hope that confidence is restored in our economy this year. Now, the budget speech will be held on the 21st of February 2018, and it's a well-known fact that we are plus 50 billion short. There is not enough taxpayers to carry this burden, and an increase in the VAT rate may have very disruptive consequences. Wealth taxes will also not really solve the problem. If the marginal rate of tax increases again, then we should really seriously start revisiting our financial goals. We may have to reprioritize our goals. However, we have very little room to play when it comes to retirement. How often do we hear that 3 to 6% of persons cannot afford to retire? We will have to start looking at other options. One is, for example, to postpone a retirement to a later date or have a plan B in place. Another way of thinking is to ask whether the concept of compulsory retirement should not be challenged. Why must I retire? Why can it not be a choice? Latest trends in the retirement legislation shows that we are moving in that direction. That is, the date that you have to retire from a retirement annuity is no longer 70. It can be indefinite. Persons can move their funds to preservation funds or extend the exit from their pension fund after the date of retirement. After all, retirement is just but a day in your life. The beauty about investing into a retirement fund is that the higher the tax rate increases, the bigger the tax deduction. A retirement annuity is thus a tax increase neutralizer. Coupled with that, it remains a perfect vehicle to plan for a retirement goal, albeit only a day in your life, but you get to choose that day. Also, a retirement annuity in its current format may solve many other estate planning problems as well, and there's no longer a pure retirement vehicle. The only drawback is that as a quid pro quo for the tax relief afforded by SARS, is that 2/3 of the fund must purchase an annuity. But that may suit the risk profile of many retirees. So depending on personal circumstances, the retirement annuity becomes a very valuable, tax-efficient investment vehicle. Let us first see what we are going to discuss today. My intention is to focus on the current tax deduction after the many changes to legislation since 2015. A major change and challenge because of latest legislation is that a taxpayer must be able to calculate his complete tax calculation before he can calculate his maximum retirement contribution. This was not the case in the past, with the result that taxpayers who receives trading and business income as opposed to fixed salaries may often need the assistance of his tax practitioner who completes his tax return. Another major positive change is that the capital gain upon the disposal of a capital asset may also be taken into consideration when calculating the retirement annuity contribution that may qualify for tax relief. Therefore, if the capital gains tax rates or inclusion rate increases for the 2018-2019 year of assessment, that's now next year, a retirement annuity may also provide some relief to offset the negative tax effect. Also here, certain knowledge of a taxpayer's affairs may only be known to the tax practitioner. For example, the calculation of the base cost of the capital asset, method of valuation, etc. So let's have a look at the agenda quickly. Number one, first of all, why do we invest in a retirement annuity fund? Then I'm going to present a short case study, a very, very simplistic one, because that is perhaps the best way to explain the fundamental principles. I'm going to do a basic tax calculation and explain some terminology that's important to understand in order to have an understanding of how much I can deduct. I'm going to deal with the current legislation to calculate it. I'm going to do the calculation, and I'm also going to play around with other scenarios just to illustrate some aspects where people may go wrong. The question is often asked that what if I make excess contributions? Will I still be able to claim that? What is the legal position? And I'm going to show you a couple of scenarios. And then what options at retirement I have is a very important choice for taxpayers, because you get one chance to get that correct. And tax is an important aspect that must be considered. Okay, so let's move on. And where do we start? What is the nature of a retirement annuity in the planning landscape? Well, let me start off with this. I call it now the eighth wonder of the financial world. Because a retirement annuity, the meaning, as it says, is for retirement purposes. But since around about 2015 or earlier, a retirement annuity changes character to a large extent. I refer to it as one of the most perfect tools to solve a lot of estate and financial planning problems. So I call it a retirement annuity. I say it became an estate planning tool because you're going to see I'm going to compare it to a trust. A retirement annuity is nothing else than a trust that is established and regulated by statute. Serves a very same purpose than these popular trusts that people set up. From a financial planning, it's always important, not only for retirement, but what about post-medical expenditure? And in order to help you to receive your lifestyle goals after that day that you're into the retirement phase. It's also a tax planning tool, not in order to minimize tax, but at least to decide how much you want to pay and when. And that relates to income tax, capital gains tax, and estate duty. And this is important from an investment growth perspective because these taxes are not applicable in the fund itself. So the growth of the fund has got a better chance to perform because it doesn't have that additional cost of tax. So although it was historically and primarily intended for retirement purposes, I maintain that the retirement annuity actually solves a lot of estate planning and financial planning, and as a tax planning tool, these problems. But let's have a look at our wealth solution quadrant. There you see it. You've seen this before. And our philosophy, our value proposition is that we assist clients to create wealth and show them how do we plan in order to build that wealth. So on the left-hand side, you will see which refers to the asset side, that is create and build. And on the right-hand side is the liabilities, that is what you want. These liabilities is things that you want to do in the future, like retirement, but you must be able to quantify that and bring that back to a present value. Therefore, I call this our little balance sheet of life. We've got assets on the one side and liabilities on the other side. So let's have a look at the first asset on the left-hand side. That is your capability to produce income, whether you're an entrepreneur, a farmer, or a professional person. You have so much money. What do you want to do with that? How do you match your assets and liabilities? That is by giving purpose. Giving purpose is to live and to enjoy, to go the overseas holiday, to provide for the education of your children, and in our particular instance, for the date of retirement, to have some independence that I have, and there you see a passive fund that would replace my asset, my capability to work, to some extent, all of it, in order to give purpose to my life, and that is to go overseas, etc., etc. Some people want to use it for passions and legacy, which is fine. If you want to turn it into a hobby and go worldwide travel, well, then you must plan with it with your assets that you have built up during your lifetime. So this is where we come from. Then, when you're prior to the age of retirement, it's always important to make sure that you protect these goals. So, for instance, if you're planning to save for retirement for yourself and your spouse, what would happen in the event that you passing away? So those funds cannot accumulate. It would be a good idea to protect then the retirement of the spouse, because if there's not sufficient funds, it has got to be supplemented with risk cover or group life, or you can also incorporate that into your pension fund if you wish to. So plan and protect as part and parcel of building the wealth. Right, let's get down to the nitty-gritty. Let's have a look at the tax calculation, because after all, this is all about taxes. So look at the income tax rates for the year 2017 on your left-hand side, on the right-hand side for 2018. So I went back 1 year and say the maximum marginal rate was 41%. But what happened 1 year later? That was the beginning of last year in the budget speech. The rates went up, another band was introduced, and the marginal rate went up to 45%. So it jumped from 41 to 45. Now this is important from a retirement annuity point of view, because I did call it a tax neutralizer. If that marginal rate would increase to 50, let's say 50% in future, remember, if you contribute to a retirement annuity, that contribution qualifies then for a 50% discount. Because the important thing is I must stay on my goal, that is to reach retirement. So technically, the fact that the marginal rate is being pushed up doesn't really affect me. And it still makes sense to contribute to a retirement annuity because my goal has stayed exactly the same. No need to postpone the goal because I've got less disposable income, because I'm putting the monies into a retirement annuity fund. So let's do a quick example. Let's assume a person earns an income of 600,000. They have done a tax calculation in 2017. So what would have changed 1 year later? Well, there it is. In 2018, there you see the middle column. His tax due is 153,000, and it was 153,000 for 2017. Not a big deal. But let's assume he contributed to a retirement annuity fund. And for the purpose of this illustration, there in the red, it's 165,000, which is correct, and I'll show you how to do the calculation later on. But look how the tax due has dropped significantly. That's why a retirement annuity or retirement funds, that includes your pension and provident, all of those funds aggregated, massive deductions are available, and that is one of the best tax saving tools, and still you yet stay on track with your goal for a retirement day. So let's do another example. Let's use a higher amount, and we look at a person who contributes 1,500, who's got a gross income of 1.5 million. His tax due in the previous year would have been 520,000. In 2018, oh, it's more or less the same. It's not a big difference, but look what happens if he would contribute to a retirement annuity fund. In this instance, he was able to claim the maximum, calculation I'll show you just now, of 350,000. The Davis Tax Committee in the second report did actually mention one should looking at increasing that amount. Nothing has happened, but it would be welcome if that would happen. So in this particular instance, the tax saving, if you go lower down in the right-hand side column, you'll see that the tax saving is 143,501. That's a lot of money that would have gone to revenue, but now it's going towards your retirement goal so that one day you can utilize those funds. All the growth because of that saving also builds up in a tax-free environment. So let's do an example, and this is my case study. See if you can commit to memory these simple facts, and then I'll show you the tax calculation. So in this particular instance, Mr. X, in the 2017-18 year of assessment, and that is now coming up to 28th of February, you will do this calculation. Mr. X sold his collective investment for 540, and he received them, or he bought them 10 years ago for 100,000. Now he wants to know what is the maximum that he can contribute to a retirement annuity fund for the 2017-18 year of assessment, and it must qualify for tax relief. He's currently contributing 8,486 to a retirement fund, be it a pension fund or a retirement annuity, whatever. Let's assume it's a retirement annuity. He has the following income and expenditure. He has a salary of 1.4 million. He's got interest income, 100,000. He's got dividends of 20,000. He's got trade income, that could be a rental income or royalties from the book or any part-time work that he's doing, which is 500,000. And let's assume the expenditure in order to produce that income, it is deductible, and I refer to that as trade expenditure, and that is a deductible event for income tax purposes, and let's assume it's 100,000. So there is a very good example of a person receiving salary plus other trade income. The calculation is actually very easy if one is a salaried person, but the moment there are other income available or capital gains in a particular year of assessment, how to do the calculation becomes important. Right, there are the facts. Sold a collective investment, he's contributing to a retirement fund, he's got a salary, interest, dividend, he's got a trade income and trade expenditure. Now before we do the calculation, there are three concepts that we must understand. Number one, you must know what remuneration means. Remuneration is usually that what an employer will pay to an employee, and often pay as you earn will be deducted. We must also know what does taxable income before including capital gains tax mean. Taxable income is the amount that will be used to calculate the tax that you have to pay. But we need to calculate the amount before we include a capital gain, and then obviously the third one is the total taxable income after including a capital gains tax. So it's important to distinguish my taxable income before I include a capital gain and after I've included, and then also a remuneration. If you understand those three concepts, and you can find it on a tax calculation, then it becomes very easy to calculate the contribution to a retirement annuity fund or a retirement fund that qualifies as a deduction. So let's do a tax calculation. Based on the information in the case study I gave you, there it is. Have a look. The salary is 1.4. You recognize that. The interest, the dividends, and the trade income. That all counts for gross income. But remember that the interest income, there is an exemption of 23,800. So obviously that is not included. So everything that is exempt cannot be taken into consideration. And then also we have dividends. Although a dividend is included, you will see lower down than a dividends excluded. Now I know that you pay dividends tax, but that's not accounted for in the tax calculation. So technically what I'm saying, whenever you receive a dividend, one cannot ever take that into consideration to calculate the maximum amount you can contribute to a retirement fund. So after we've taken the gross income less the exemptions, that gives us the technical term income. Now there are certain deductions. Trade expenditure, because it's expenditure incurred in the production of income for purposes of trade, one may claim that a deduction from tax. And then you see in bold, taxable income, 1.8 million something. That is the concept I said that you must understand. Then you get a taxable capital gain, which is calculated by taking the proceeds, less the base cost, less the 40,000 exclusion, multiply with the inclusion rate, it's 160,000. And you add it to taxable income so that you get the concept, and here's the third one we need to know, total taxable income. So there are three things that we must know. Total taxable income is 2 million something. taxable income is 1.8 million something, and remuneration in this particular instance would be salary. So there are the three things that we must know. So let's just dip a little bit deeper into each one of them. What is remuneration? Well, it's defined, if it's in there, in the definition it is. And there you go. It is salaries, leave pay, wages, overtime, bonus, gratuities, commission, fees, etc., etc., etc. Even pension. All of that is remuneration. So when we're going to do the calculation and we're going to refer to remuneration, we can always go back to this definition and say, does it fall into this? Usually, one can say where pay as you earn is deducted from it. All right, so let's go and start with the calculation. Here's the tax calculation I've shown you before. Now, in order to claim a retirement annuity deduction, and you can guess, it will fall under deductions there somewhere, where we're going to claim it, we have to do a full-on tax calculation first. That's what I said in the introduction. You must first do a full-on tax calculation and then be able to calculate a retirement annuity. Now what the Act says is a Section 11 capital F. It used to be 11K and 11N previous years. Now, since the 18th of December 2017, it's 11F. What is underlined there is important. What will be allowed, I read in the middle, as a deduction. The deduction, look on the left-hand side, where it says deduction, it will come in there. Is the amount that a person contributed. If you didn't contribute, you can't get the deduction. So obviously, if you qualify for a massive amount, let's say 350, but you only contributed 100 Rand, you can only claim 100 Rand. It is the actual contribution that is important. So let's see then, where would the retirement annuity deduction then be inserted before we redo the calculation? So on the next slide, and there we go. Do you see in the red? Retirement contribution will be added on there after we've calculated it, and then we have to redo the calculation because it's going to reduce our tax due. So let's go to the next slide. The retirement contribution may be towards a pension fund, provident fund, or a retirement annuity fund. So it's the aggregate. So if you contribute to a pension fund and you're not contributing the full amount that you can claim, you can actually contribute to a retirement fund as well. You can always make up the difference. So many salaried people who are contributing to a pension fund will find there's a lot of leverage left where you can actually contribute more to a retirement annuity and qualify for the tax deduction. Another important point, it's immaterial from a tax perspective, therefore, whether the employer made a contribution on behalf of the employee. That would only account for a fringe benefit, and that forms part of remuneration. So the employer is contributing 50,000 towards a pension fund for the employee. That 50,000 accounts for as a fringe benefit, and it's as if the employee has made that. So the only question remains is how much can we deduct in total? And here comes the formula. The total deduction allowed in a year of assessment may not exceed the lesser of three things. A, 350,000, or 27.5% of the high of a person's remuneration or taxable income. Do you remember I said you must know the terminology definition of remuneration or taxable income? Well, there it is. Or C, which is a new invention with the latest legislation, the taxable income of that person before allowing of any other deduction and any taxable capital gain. And that was the third part that I showed you. You must know what's remuneration, you must know what's taxable income before inclusion of capital gain, and you must know what is taxable income after the inclusion of a capital gain. And that's basically what it said. So let's go through it step by step. First of all, the total deduction allowed in terms of subsection 1 must not be the lesser of 350,000. So there where the arrow shows 350, it cannot be more than 350 because the Act says so. Or 27.5% of remuneration or taxable income. Follow the green. 27.5% of remuneration is 1.4 million. You see at the top, that's remuneration. Or taxable income, that is the total taxable income of the capital gains tax, which is 2 million. Which means, if you made a capital gain, you can claim 27.5% against that capital gain. But then comes the C part, and see what it says? The taxable income of that person. So that is a limitation. It may not exceed the less of 350, or the B part of the formula, or taxable income of that person before the inclusion of a capital gain. That is, with other words, you see there in green, 1.8 million. So that taxable income is a ring fencing provision, and it's actually a limitation. So our calculation shows we can claim, what is the amount we're going to put there in the red for retirement contribution? The lesser of 350, or the result of 27.5 times 1.4, or 2036, which is total income, or limited to taxable income is 1.8 million. Therefore, the answer is 27.5 multiply total taxable income is 559. But we are limited not to 350, but to our actual contribution of 101. Remember in the facts, we stated he actually contributed 8,500. So this particular person can qualify for up to 350,000. So he's got a lot that he can contribute more before the end of February in order to claim the maximum deduction. So let's do another example to make sure that you understand that. What if a person only has a capital gain and no income? Because I did say you can apply the formula and use the capital gains. This is where the ring fencing kicks in. So in this instance, the answer would be the lesser of 350, or the result of 27.5 times naught, because remuneration is naught, or taxable income. That is total taxable income, which would be 160,000, because it includes capital gain. But limited also then to taxable income before allowing the inclusion of gains, which is naught. Therefore, in this particular answer, the answer is naught. So, many people tend to think it's 27.5% of taxable income, which is 160,000, but no, there is a limitation, and that is the importance of the C part, that it is naught. Let's do another example. What if a person's salary is the same as his capital gain? Well, A is 350, B is the result of 27.5% of remuneration, which is 160, or taxable income, total taxable income of the included capital gain. So that is 27.5% of 320,000. But you are ring fenced to the C part, taxable income before inclusion of capital gains is 160,000. So the answer is, in this particular one, 27.5 times 320,000 is 88,000, and the ring fencing doesn't apply because it's 160,000. One more example. So this in particular example, you will see that it's 88,000 that's included there, and it will reduce the capital gain. So let's do one more example. The next slide. What if a person only has a salary and a capital gain exceeds his salary? This is where the red flag comes up. So I'm not going to go through the full calculation, but the B part says the deduction is 27.5 of 210, total taxable income, which is 57,750. But however, in terms of the C requirement, the deduction may not be more than taxable income, which, as you can see there, is 50,000 Rand, before allowing the inclusion of capital gains. Therefore, your retirement annuity contribution is limited to 50,000, which means your taxable income is 0, but there is still a total taxable income. This illustrates very clearly the ring fencing effect. Okay, that is what we need to know about deductions. Now the question is, what if a person made excess contributions? And there's the legislation. And you have essentially three options. Let me explain it and simplify what the Act says. It says, if you made excess contributions, you made more, as we did in some of the examples, you made more than you actually qualify for. Do you lose that? They say no. It's deemed to be a current contribution unless you claimed it in the current year. So the surplus can be claimed in the following year. Or you can add it to a lump sum at retirement. Or you can set it against annuity income once you've retired. So let's have a look. So let's assume that one qualifies for 350,000. So if a person, in our first example, we assume that he contributed R1 million, which is in excess of the 350,000. So he contributed, he didn't work, I says, I'm just going to throw in R1 million. I'm not sure how big my deduction is, but tell me what will happen because I've contributed more. So let's assume everything stays the same just for purposes of illustration. That means he may claim in the following year. Now, in the first year, he would have claimed 350,000, and the following year, he can claim another 350, even though he didn't contribute in that particular year. It rolls forward until it's exhausted. So the balance of 1 million minus 350 is 650. It's available each and every year. And that amount can be deducted even though no actual contribution is made. Remember, the growth in the retirement fund will be tax-free. So it's growing there while there's lying. You only get the deduction in the following year and the following year. But what now happens, let's assume the taxpayer has made an excess contribution and he retires in the second year. What about the unclaimed portion? Well, this is where you can add it to the lump sum on the retirement. So when you go into retirement, on the date of retirement, there's a tax on the lump sum, and you can take up to 1/3. So in my example, Mr. X retires from a retirement fund with a benefit of 6 million, and let's assume he receives a lump sum of 2 million. He commuted 1/3 of the 6 million. So 4 million is going to annuity, and 1/3 is 2 million. In the previous example, we said that 650,000 was not deductible. What can he do? You take your lump sum, you subtract the disallowed contribution, you get 1.3 million something, and then you take that straight to the tables. Look there in bold on the right hand side. If amount exceeds 1,050,000, then you apply the rate of tax, which is in bold there, 130,500 plus 36% of the amount that exceeds that 1,050,000. And then on the left-hand side, I did the calculation, and therefore that would account for the final tax, which is 238,000. So you actually get that credit. It's taken off your lump sum. But now, some people say, but I don't want to take a big lump sum because I'm going to be taxed on it. I want to take the minimum just to settle my debt. Will I lose out on the deduction? Nope. And this is where the third leg comes in. You can set it off against annuity income that you receive in retirement. So, the next example, let's assume the taxpayer took a lump sum of 500,000. Remember, we can take up to 1/3. That amount would be tax-free according to the tables, and then he decides to take an annuity income of 200,000 pounds. So he's not taking the full 2 million. So on the 500,000, he won't pay tax because he didn't retire from other funds, and that amount is basically tax-free, and he settles his debt. So the balance is thrown to annuity. Then the calculation on the left-hand side will show. Your annuity is 200,000 because it's gross income. That 200,000 is an exemption that you will get, and that is until the full balance of disallowed contributions is exhausted. So you can actually qualify as annuity exemption in the years of retirement, that this person will not pay a single cent of tax. So all those disallowed contributions, you have options available that will have an influence on how much you're going to take your 1/3. because you can use that as a tax-free portion, or you can decide rather to take a smaller lump sum and then take a bigger annuity and then get an exemption against that annuity income for later years. And so until the full 650,000 exhausted, that will happen. I've dealt with income tax. What about estate duty? Because if you put a lump sum into a retirement annuity, there are no estate duty payable on the proceeds of a retirement annuity. However, there was a change in legislation and say only on that unclaimed portion that you're getting the tax relief, as I explained to you, on that amount, we're not going to allow you to be estate duty free. So there I did a estate duty calculation. You will note that the amount of 6 million, escapes estate duty. But the disallowed, assuming now 650,000, that will be added on and you will pay estate duty of 20% on that. So note that the 6 million escaped estate duty, as I said before. Okay, so let's have a quick look. What do we make of this? Some strategies. When it comes to financial planning, it's about the options you have, and at the date of retirement, you must know and understand your options. First of all, let's have a look at retirement annuity as opposed to a trust. Secondly, another strategy is to say that, well, if there's going to be tax increases in the coming budget speech, I still stay on track with my goal because I get a bigger deduction. And let's look at post-medical aid expenditure, something that's very important, because if in our budget speech or later years they're going to take away the medical credit, it becomes extremely important that we must make sure that we can supplement our expenses after the age of 65. But let's deal with the first one first. Let's compare a trust with a retirement annuity. Now, the first thing is, they're very much similar and the same thing, except for the tax treatment. On the left-hand side, you find the trust, on the right-hand side, you find the retirement annuity. What is the purpose of both? The purpose is that the benefits of those funds must be for the benefit of the beneficiaries. So on death, usually my children and descendants and spouse, and that is the case with the inter vivos trust and with the retirement annuity. A retirement annuity does exactly the same from a purpose point of view that a trust does. You want protection against creditors. That's why some people would set up an inter vivos trust. Well, guess what? In terms of the Pension Funds Act, you are protected against creditors by legislation. The big difference comes in. The funding of a trust, very negative since latest tax and anti-avoidance provisions. With the retirement annuity, you get a tax deduction. The investment build-up in a trust is subject to very onerous capital gains tax implications. If it's in the retirement annuity, there is none. When it comes to a trust and the distribution of benefits, income, and capital to beneficiaries, then there are anti-avoidance provisions because some people can abuse the tax base. With a retirement annuity, there are none. You can select to take a living annuity, 3%, 4%, 5%, and depending on that, you'll be liable for the tax. So you can actually elect how much tax you're willing to pay. Now, this may be excellent if I have other deductible expenditure in a year or after my retirement. I can manipulate my income to the extent that I don't pay any tax. So it becomes a tax planning tool to a limited extent. So let's just summarize. Tax benefits of using a retirement fund. Many taxpayers have limited tax breaks available. With the retirement annuity, let's sum up. Contributions to a retirement fund are tax deductible. Capital gains may be used to increase the tax deduction in the year of assessment. The build-up in the fund is tax-free, including dividends and capital gains. Tax break when one retires from the fund, namely limited tax-free lump sums. Excessive contributions qualify for tax-exempt income after retirement. Tax is deferred until 65, when income decreases and tax advantages are available. The accrual of income after retirement can be adjusted to reduce tax or when necessary, tax-deductible expenditure, medical expenditure are incurred. So from a tax point of view, a retirement annuity just ticks all those boxes. So where does it fit in? So let's just go back to the why. What is the role of the financial planner? The financial planner's role is, together with the investment team, with other specialists, to actually coordinate and act as a project manager. And he's got one thing in mind, and that is to get to your goal. Your goal in this particular instance would be retirement. So together with this team of experts, and I can imagine with the retirement annuity as to the final calculation, if you have taxable income, that the tax practitioner plays a very important role. But it's your job, the financial planner's job, your job and the financial planner's job, to make sure that you reach that retirement goal. Thank you very much for attending the webinar. And if you'd like a personal consultation with a Standard Bank financial planner, you can simply SMS the word advice to 31791 or call that number on the screen, or you can email us and an appointment would be arranged for you. So I don't know, are there any questions that we have to attend to? Teresa, yes?
Yes, Errol, thank you. We have a few questions. Here's number one. Do you expect the tax deduction to change in the budget speech?
Well, I think it's as good as it gets. It's unlikely, but I'm doing guesswork. It's unlikely that they would increase that, because what we've been given, it is so generous. So I don't think, it is not never impossible, but what we receive at the moment is so much. And for people that are earning about 1.3 million upwards, there's already a limitation in place of 350,000. I think it's unlikely, but what's important, if the marginal tax rate goes up, just remember, what is it that you want? I want to stay on track to reach my goal, and that is to retire. So I don't care less if the marginal rate is going to be increased. All you have to do is just keep on contributing to the retirement annuity, and you will get a deduction to the same percentage what the tax rate has increased.
Okay, what if I'm currently making contributions to a pension fund? Can I also contribute to a retirement annuity?
Absolutely. That 27.5% formula relates to all the retirement funds, which is pension fund, provident fund, and the retirement annuity fund. You cannot claim 27.5% for each. You have to combine them. So most employers, let's say the employee would contribute 10% to a pension fund and the employee would contribute 7.5%, then you've only used up 17.5%. You can actually add another 10%, and with that you can purchase a retirement annuity so that you have the benefit of the total 27.5%.
Do you think that the marginal tax rate of 45% will increase in the upcoming budget speech?
I wish I knew, but this is going to be one of the most important budget speech ever. But as I've stated before, monies need to be found somewhere. It's going to be a very difficult call, and chances are that the marginal tax rate, and this is what people say, should be increased. If that is the case, you will have less disposable income, there's no doubt about it, but at least contribute then the maximum to the retirement annuity so that you can get the maximum deduction.
And what is the retirement date for a retirement annuity?
Years ago, they set the retirement date at the age of 70, then you have to retire from a retirement annuity. And I mentioned earlier, there's ongoing legislative changes that gives people more flexibility, because really, it's tough to have a date to say that you should retire on this particular date, and now all these elections that you have to do and tax consequences, that is actually unfair. Times have changed, people live longer, so legislation was changed some time ago that the retirement date for retirement annuity is no longer 70. You can retire whenever you want to from that retirement fund, which gives you the opportunity to contribute to a retirement fund as long as you wish.
Thank you so much, Errol. The webinar can also be watched on YouTube, and for our internal staff, they can also find it on the SBFC advisory portal. Thank you so much for joining us today. Enjoy the rest of your day. Goodbye.